Welcome back, ladies and gentlemen. My name is Joshua Castillo. If you are interested in value investing, interested in trying to get a better idea of what that actually means, make sure to like and subscribe to the channel. I mean, that's what we're doing here on the channel. We're trying to explore different ideas, what it really means to value invest, and trying to see if we can find value in all sorts of different opportunities. Now, one thing I will note is today's video is on Meta Platforms. I do have shares of Meta Platforms. If you want to see my most recent portfolio update, just go to the last video that I posted before this one, and you'll be able to see it. But really, I just want to give a disclaimer. This is not financial advice. This is just, something I'm really interested in, just showing my research and what I think. Make your own decisions, all that good stuff. But let's dive right into it. Now, for the quarter overall, I mean, you're going to see this kind of flow through everything. But as far as the balance sheet goes, one of the things that I want to note is that they had a pretty big cash generative quarter, and that's on top of them buying back shares. So you can see on the right side right here, I mean, just look at their marketable securities and their cash and cash equivalents, and look at the growth. Now, part of that growth, so it grew by, what is that? Let's call it, I don't know, like 16 million almost, 16, 17 million. Probably about 9 of that is due to that long-term debt that they had acquired this last year. Now, they're using that debt to basically fund their business. They had a really good balance sheet, before they started putting on debt back in 2022. So they have the balance sheet to be able to manage this debt, and the debt was really, really low rates. So I'm not too concerned about the debt. But just so that way, when you're looking at this, it didn't go from like 41 to 14 all of a sudden. They just grew their cash quite a bit. So I just wanted to note that real quick so that way it didn't seem like so shocking that they were able to do that in the course of 1 year. Now, the other thing that they did as well is they have been restructuring. So you're going to see a lot of different things come from accrued expenses and things that are tied to that restructuring, but we'll talk about that in a future slide. Now, looking at the income statement, it is wild how different the last 12 months versus 2022 look, and it couldn't be any better. And the turnaround as far as like 2022 to now, and I'll look at that towards the end of the video, but the stock price has gone crazy because of this turnaround. And a lot of times you'll see often that the stock price follows the free cash flow, it follows the cash flow generative companies. So it's really interesting to see, like, when the cash flow dips, everyone gets scared and runs out the door. Now, revenues as a whole for the quarter and for the year, revenues was up $40.11 billion for the year, or for the quarter, and then $134 billion for the year. Now, an increase of 25% on the quarter and 16% year over year for the fourth quarter and full year 2023. It would have been an increase of 22% and 15% on a constant currency basis. But still, to go from, next to no growth to all of a sudden, coming out the gates, firing this entire year has been pretty incredible. Now, as I mentioned earlier, total cost and expenses was $23 billion and $88.15 billion for the fourth quarter and full year, a decrease of 8%, an increase of 1% year over year. Now, the expenses would have been higher year over year and really just across the board, again, had they not laid off so many people and had a lot of restructuring costs due to that. Now, going on that capital expenditures included in principal payments on finance leases was $7.9 billion and $28.1 billion for the fourth quarter and full year respectively. And again, if just looking based on the income statement that you see on the right there, a lot of what they drove was that cost and expenses section. That's where a lot of that restructuring was happening. So you can see marketing and sales is down slightly year over year for the full year, and it is also down very slightly for G&A. Now, the cost of revenue is up just slightly, and so is their R&D. That's not surprising because they're putting a lot of money into Reality Labs right now. So, you're going to see a lot of that come through. But it is interesting. Just look at the EPS here in the bottom. It goes from $8.59 to 14.87 cents for the diluted shares. That is absolutely crazy. I mean, just within the fourth quarter alone, it's almost like 4 times what it was last year. So this is, when you look at the stock price, this is what is driving all of this, is if this, like, last year's performance. And it seems like the overall consensus has really, really flipped. So that also helps as well. Now, there was a large increase on the year in cash from operating activities, you can see it goes from 50.4 billion to 71.1 billion. Again, part of that being the fact that they're not having to pay as much as far as, salaries and things like that. And their net income is also just up because ads in general are up. The market in general for ads is a lot more lucrative this year. As far as free cash flow goes, you can see that they decreased their PPE. So, obviously free cash flow is going to be up a little bit higher than it would have been. Part of that also comes from the fact that they're investing heavy into their AI and Reality Labs section of their business right now. So it's not really that surprising to see, this sustained capital expenditure. And then also they repurchased 19.7 billion shares. You can see the long-term debt there at the bottom that I was mentioning earlier. But it's really interesting to me, like when you go through the cash flow statement, what this all really means, and also what it actually happened to get them to the point where they are this year. They always had a strong balance sheet, but it's interesting that they found it was strong enough to actually add a dividend for this Q1 2024. Now, on that note, so they announced in their Q4 2023 report that it says today's Meta's board of directors declared a cash dividend of 50 cents per share of outstanding common stock, including both Class A and Class B, payable on March 26, 2024 to stockholders of record as of the close of business March 22nd, 2024. We intend to pay a cash dividend on a quarterly basis going forward, subject to market conditions and approval by board directors. Now, you can see here, I extrapolated. This is probably like not perfect math because they're buying back shares and they're doing all sorts of stuff. So 50 cents a quarter basically is going to be $2 a share for the full year. I think people said that Mark Zuckerberg's going to get somewhere in like $700 million, which is kind of crazy. And that's what that Class B shares are, it's Mark's position. So looking though at the Class A and Class B shares, Class A has 2.2 billion, and obviously they're buying that down. So it's possible that that annual dividend payout goes a little bit lower as they continue to buy shares, but they're going to pay about $5 billion of their cash basically in dividends per year. And that's not that's just, for this year, assuming we don't even know what it's going to grow at. But this opens up the opportunity for dividend investors now, because there was a lot of people that were not interested in this. And what ended up happening is that Meta back last year had the lowest or the biggest drop in stock price as far as like market cap move in a single day out of any company ever. And they now own the single highest. So it's kind of crazy to see this happen. But I wanted to compare it. Really, my interest is more so comparing it to the payout of the free cash flow. So 5.1 billion divided by 43.01 billion free cash flow is about 11% of a payout ratio for the free cash flow. So when you're looking at this, I think they have the balance sheets to sustain it. They have the free cash flows to sustain it. So it'll be interesting to see what this actually grows next year, because, there's not really a precedent for, dividend investing for Meta. So it'll be interesting to see what that actually looks like. And moving on, we have the restructuring. I'm not going to go through like all of this because I've kind of touched on this just a little bit. But really what it all amounts to is they basically took, laid people off. They gave people severance. They gave people some of their shares that they had earned. They also had a lot of that share-based compensation recognized as well. So really, this is kind of the total of 2023, the pre-tax charges that are associated with it, and then the severance liabilities that they're carrying on the balance sheet right now, or at least as of December 31st, 2023. So if you want to look further into this, you can go through their 10K. They really call it out. They do a good job explaining it. They reduce their size of the company between both segments a lot. I think a lot more people left or were laid off from Family of Apps. So it's not really that surprising given the whole year of efficiency that Mark was pointing to, but they wanted to go for more of a horizontal structure rather than a huge hierarchy. So, 10,000 employees out of, a couple tens of thousands of employees is quite a substantial amount. I think it was like 10 to 15%, if I remember correctly. Could be remembering that completely wrong. But it was a substantial amount to make a dent in their employee base, and it wasn't really shocking given where they were at. But moving on, you can see the segment results. This is from the earnings presentation that they had. So again, you can look at the quarter over quarter and look exactly what happened. Obviously, there's some seasonality trends here, but if you just compare Q4 versus Q4 versus Q4, you can see the significant difference. And I mean, it's crazy to me just on the sales line, 32 billion versus 40 billion, just for one quarter. Some companies don't even make close to that in a full year, let alone a couple of years. So a lot of the drive as far as their operating margin and incremental margin gains is going to come from family of apps. So you can see here, again, the operating income is substantially driven by family of apps. But the thing is right now, Reality Labs is operating at a loss. It's been operating at a loss. They basically said on the earnings call, it's going to continue operating for a loss for the foreseeable future. They're going to keep putting money into it. It's going to be a money hole. So right now, because of where the ads are at and everything as far as family apps goes, it's working because they have the cash flow to sustain it. But if something happens to the ads business, this is going to be a hole that needs to be filled very quickly. So it's something that you should watch as far as when you're looking at their financial statements. But I think for right now, it's fine. I don't really like that they're kind of burning money essentially with Reality Labs, but I wouldn't be surprised if a lot of the learnings that are coming from Reality Labs are getting implemented in various apps or things that they're working on. And a lot of the capex that they're spending is not necessarily on Reality Labs specifically. It's more so probably for family of apps. They have a lot of GPUs that they're buying from NVIDIA. Looking at the expenses as a percentage of revenue, again, you can kind of see what the fluctuation was. At one point, I mean, cost of revenue was 26%, and the marketing and sales was 30%. I mean, 33% in these two quarters. So they really had to knock that down quite a bit. So now, it went from 26% on the high end to 19%. It went from 33% to 26%, and they knocked it down a little bit on these two as well. So it's this gives a good profile for what happened and kind of what caused it. A lot of, again, the layoffs came kind of like in this realm. So it's not really surprising to see the dip here after people had gotten laid off. It'll be interesting, like as the business normalizes after the layoffs and after the year of efficiency and all that stuff that had happened this last year, what the actual breakout and the margins and all that end up looking like. Advertising revenue by user geography. Again, I'm not going to harp on this too much, but you can see that overall, obviously, US and Europe contributing to this, and Asia being one of the big pieces. A lot of the bigger Chinese companies have been investing heavily into the ads for their own apps. So it's not really surprising to see Asia up quite a bit. It won't be surprising in a couple of years once China can kind of dig itself out of its economic hole, what that actually ends up looking like for Asia. I really feel like Asia in general, as far as investing goes and, business and everything as economics go, I think there's a lot of opportunity for growth and there's, a very long runway. It's just, can the countries actually foster that growth and let people build businesses that are sustainable and grow successfully? So that'll be the question. But as far as the breakout, again, a lot of it's going to come from the US, and then the secondary is going to be Europe. And again, that's kind of when you look at the breakouts of everything, those are kind of the two high driving business or segments of their, business basically as far as what's contributing. Now, family daily active people, they stopped reporting like every single user metric. This was one of the ones that they're kind of focused on going forward. So you can see really it gives a good look at what has happened over the business. Now, this is in billions. So 2.8 billion to 3.19 billion over the course of, 2-ish, 3-ish years is kind of insane as far as their family daily active people. So to have that be something, there's 7-8 billion people in the world, and you have a third of that, and you would think at some point it would stop growing. There was a point where I think it was monthly active people or monthly active users slowed down for like a second because of Ukraine and everything that happened. Then it ticks back up and kept going. So it's crazy to me that you have a third of people on your apps using your apps every single day. And part of that is because a lot of Asian countries that have a big population like China and India are coming online and, more and more present online, especially India. A lot of people are getting smartphones, and, it's very, very much rapidly developing story. So it'll be interesting to follow going forward what actually happens. Again, family monthly active people, same story. It's gone up from 3.59 to 3.98. So, it's people who have checked in at least once a month on their family of apps. And they were tracking Facebook, and I think they're going to focus now on all of the apps. Now, there is some, obviously like duplicate accounts that people have multiple accounts. But they try to correct for that when they give numbers, but obviously it's not always going to be perfect. But 3.98 is substantial as well. So looking at the free cash flow, again, money follows the free cash flow. Stock price follows the free cash flow. So just looking at what happened to free cash flow, you can just see it, it's very obvious what happened. So you went from 12 billion in Q4 2021 to 173 million in Q3 2022, and then now we are up to 11 billion in Q4 2023. And the free cash flow over the year was, substantially higher than where 2022 had ended, which I'm very happy about, but they got to continue to build on this, but invest into the business as well. So we'll see what happens with the business and how they invest that money and what they do with that free cash flow. It seems like overall they're giving it back to the shareholders, and that's kind of the goal. So I really like Susan Lean, what she's done, and the CFO has done a fantastic job running the business alongside Mark. So I really like where they have come out to as far as the decisions have come, and properly leveraging the balance sheet, not getting too over leveraged. But it'll be interesting to see, like right now we're kind of like ramping back up as far as ads go. So it'll be interesting to see if we have any, slowdowns, declines, or anything like that in the future, what that actually plays out like for Meta. Now, getting on to the earnings call, I picked a couple of questions. This is not like all encompassing. If you want to go, they actually post it, transcript, they post it, but there's a lot of other apps and things like that where you can go listen. I just want to focus on a couple of these because I think they're pretty relevant. So Eric Sheridan said, thank you so much. Maybe 2 questions if I can. Mark, coming out of a year like you had with the year of efficiency, what do you see as a key message you want to share with your investors about what you learned during the year of efficiency and how it might inform a running organization with the scale of ambition, just an organizational scale that Meta has on a long-term basis? That would be number 1. And then Susan, I went back and looked, and I don't think you ever raised the high end of your CapEx guidance before, unless I'm mistaken. But with a wide range like that in CapEx, what should we be monitoring for what you would push towards either the lower end or the higher end of the CapEx guidance as you move through 2024? Mark said, I'll take the first one. So the themes for the year of efficiency were to make us a stronger technology company by becoming leaner and more balanced towards our engineering work and more streamlined, and to improve our financial performance, primarily with the goal of proving stability so we can invest in these long-term ambitious visions and around AI and metaverse over what we see as coming decade or more as these things play out. And I think a lot of people looked at what we were doing as if it might have been some kind of short-term thing, which is never really our focus, but the part about making the company leaner, I think, is really important to take forward, right? Because obviously we're in a place now where the business is performing well. And I think the obvious question would be, okay, well, given that, should we invest a lot more in things? And the biggest thing that's holding me back from doing that is, at this point, I feel like I've come around to thinking that we operate as a leaner company. So even though there's always questions about like adding a few people here or there to do something. And I guess I just have more of an appreciation of how all that adds up. And in the near term, maybe it makes you go a little bit faster, but over the long term, the discipline to kind of hold things to a more streamlined level actually improves the overall company performance. So I'm really focused on that. In 2024, we do a big recruiting backlog from last year because part of the layoffs, we did include teams basically swapping out certain talent profiles for others. We still need to hire some of the other talent profiles that we swapped out for, and that will be ongoing throughout this year. But in terms of new headcount that we added to the plan, it's relatively minimal compared to what we have done historically. And I sort of expect that for the next period of time going forward, even beyond 2024, my operating assumptions is that we'll also try to keep it relatively minimal, because I think that until we reach a point where we're just really underwater on our ability to execute, I kind of want things to keep things lean, because I think that's the right thing for us to do culturally. So that's kind of the best window of how I'm thinking about it. The other piece that I guess somewhat dovetails into what Susan is going to talk to you next is a big part of why I wanted to improve profitability, is to give ourselves the ability to go through what is somewhat unpredictable and volatile period of the next 5 to 10 years. And there are different risk factors, or geopolitical, regulatory, or different things, but also the technology landscape is somewhat unknown. We want the ability to surge investment on things like building out larger training clusters or making different investments where that's necessary in order to make sure that we have the flexibility to do that. We just want to make sure that we keep our cost structure to a point where we sort of have have some extra space built in. So those are really 2 points. That was the themes that I laid out at the beginning of the year, and the year of efficiency last year makes us a stronger tech company and gives us the flexibility and stability to execute the long-term goals. And those remain, I think, the biggest focuses and forward on that. And Susan Lee said, and I can take the second question. So we really are continuing to evolve our AI roadmaps and our ambitions, our understanding of the capacity demands that we might have as we train the next generations of foundation models and to support all the associated product development going forward. So increasing the top end of the range really reflects that evolving understanding of how much demand we may need. And we're also continuing to keep a close eye on supply availability. Where we land in that range is a function of both the supply and demand factors I mentioned. And this continues to be a pretty dynamic planning process for us. And there are certainly other factors that drive uncertainty. How quickly can we execute on the new data center architecture, how the supply chain turns out to unfold over the course of the year. But our expectation is generally that we will need to invest more to support our AI work in the years ahead. And we're seeing some of that reflected in 2024. Again, overall, I think that the year, what they've done on the year and the things that they've talked about in the year, they've executed to. What you're seeing here, as far as the one thing that I pulled out of the earnings call, there was way more questions, things that they dove into. But this is like the one thing I wanted to call out because I think it's important from a CapEx basis, what is actually happening with the business and what they're planning on doing. And they're going to spend on things that impact AI and things that impact their learning language models because that is what they believe the future is going to be. So when you look at companies like NVIDIA that are making these H100, H200 GPUs, they need, Meta needs those GPUs. They're actually one of the biggest customers of NVIDIA, and I think they're the second biggest customer. I think Microsoft's first, but they make up a huge substantial chain of NVIDIA. So it's something to watch for because if, God forbid something happens to NVIDIA or to TSMC where the factories are making these chips for NVIDIA, that will impact Meta substantially because right now, the need for GPUs, the demand for GPUs is way ahead of where the supply actually is. There's not really a supply just there to grab from. So they have to do a lot of ordering, have to pay a lot of money to get this stuff ahead of time. And so it's something to pay attention to because a lot of the strategy for Meta relies on AI, being able to be developed using these GPUs and using these data structures basically that they have been building. So overall, though, I think that the quarter was pretty good. I think that the year was really good, especially relatively to 2022. I think that the stock market, as far as people's feelings about Meta, I was tweeting about it and seeing what people were tweeting, old tweets that people had, and it's crazy the consensus shift that happened. I think at some point we were below a 10 PE for this company, and now we're sitting at a 30. So let's take a look at the valuation, what I think it's worth. Again, could be right, could be wrong. I have no idea. I don't know where this is going to end up. I have no clue. I'm not a fortune teller. What I can do, though, is take some things that I think may or may not be reasonable and try to figure out where it actually lands. So for me, I just plugged all of the different financials into my model. So again, outstanding shares, current revenue, free cash flow, and net income. Those all come from the financial statements. The current PE right now is 32. Now, when you look at something like ticker.com, you can see that the next 12 months, so the 2025 PE is around 22, 23. So if that growth, as far as what they're projecting, sustains, then it might be fairly valued right now. But for me currently, where I see the business at, this was the first year in a couple of years, really the first quarter, where they were able to hit above a 25% margin on free cash flow and on net income. I think that part of that is being driven by the fact that they restructured. So currently, when I'm looking at what I'm projecting, the model itself is basing 7 years. So I have to look 7 years into the future and try to think of what's the average going to be as far as the growth rate. What do I think in 7 years the PE is going to be, the price of free cash flow is going to be. And I think that for the most part, PE and price of free cash flow have followed each other pretty well. They're pretty close. So I just kind of model them together. But in some other companies, that's not always the case. And sometimes depending on how complicated the net income piece is, if you look at Berkshire, it's not very straightforward how you get to the profit margin of the business. So that's why I have it built like this. Most of the time I try to make free cash flow and profit margin equal to each other, pretty close to give me a ballpark. But taking a look at the model, though, you can see on the right side, the revenue growth goes from 6% to 9% over the course of 7 years. I think right now, I just checked Ticker right before recording this, next year is projected to be like a 12% top line growth, and I think the year after that is supposed to be like, 10 to 12%, or maybe 15% next year and 12% the year after that. So I was like, let me just go with the safe route and go 9% on the high end, 6% on the low end, and see, where it all lands out. Profit margin, again, they're investing heavily into Reality Labs. It is a money hole, but if Family of Apps can outstrip it, and maybe at some point, we get some more sales for Reality Labs, it's possible that the net income margin and the free cash flow margin end up going up quite a bit. So for right now, though, I just left them at 25% to 30%, 30% on the high end, and then as well as the terminal PE and free cash flow from 18 to 25. And really what I'm trying to show, at least for myself, is like if they hit on everything, and let's say they can grow, 9% a year at 30% profit margin, and, if they can, they can do 9%, 25 PE is probably about right. And 12.5% discount rate, what is that actually equal to? So the bottom left is where you can see those numbers play out. If the high end of this scenarios play out, $416 is what I think it's worth right now. I think it's probably in between like $300 to $400. If I really had to give like a fair value, it's probably like, $350 or somewhere around there. If I really had to give like a ballpark, I think that the worst case scenario is probably pretty low for what it is, but I just wanted to see like what does it all actually look like? Because the profit margin, free cash flow margin that's there, it's not like that, it's not never happened before. So I wanted to give kind of a realistic scenario of what I'm looking at. Now, 10% of my portfolio is currently sitting in Meta, and my cost basis is $180. So I'm well below the worst case scenario. So that's part of it too, is like I'm not looking necessarily to add more to my position in this company, not because I don't believe, but because right now I like feel good about where it's at. I actually cut the position in, I think, almost in half for where it originally was, because I think it was like 25% of my portfolio. So 10% lets me sleep at night. If it keeps running, I'm going to keep letting it run. I think that the company is on the right track. I think what they're doing is good. I think that, as far as what they're showing, it seems to be working. They're adding a lot of things to their ads business, like inserting reels, having Vantage Plus shopping, that is generating a lot of revenue. Now it's just time to monetize some of the things they haven't monetized yet, like WhatsApp and click to messaging and stuff like that they're currently working actively right now, especially with reels becoming, not cannibalizing other things and actually becoming neutral on the year. That'll help going forward. So as long as they can stay ahead of the rest of social medias, I think that the current valuation may or may not be justified. But if I had to give like a meter as far as my feeling about it and where it's at, I don't think that we're at a bearish consensus anymore. Right now, sitting at a 32 PE, it's not undervalued by any chance, of like, things that you want to find that are cheap that you actually people don't want to look at. And it's like very much in the limelight right now. So when you're looking at this, though, I just come at it from that view of this might be a company now where it's a good company, but just put it on the watch list, wait for it to get a little bit lower, and do your research and figure out what it's going to be worth in a few years. And if it falls below what you think it may or may not be worth in a few years, then go ahead and pull the trigger. But it's all up to your risk profile, how it fits your portfolio, and that's the goal of this channel. So just sort of explore my thinking and what I think, but really ultimately you have to be the one that comes to a decision, because it is your portfolio and it's what you want to do with your money that matters the most. Now, with that being said, thank you all so much for watching. I hope you enjoyed. I hope this wasn't, too long and drawn out. I really wanted to just explore this and kind of wrap up Meta for the year, because I think that they had a great year, and I think that overall, shout out to the Meta shareholders that have been holding since 2022. This is a very big lesson in, holding something long term and not just getting out of it for the sake of getting out of it. And it couldn't have happened in a better way, but it was very stressful when it was down like 50%. But with that being said, thank you so much for joining me today. I hope to see you again. Have a great day and happy investing.